and I'm going to focus on biases. But let's just look quickly at behavioral finance. What is it? Commonly defined as an application of psychology to understanding human behavior in finance and investing. Now, the efficient market theory, which states that all equities are priced fairly based on available public information, is often kind of criticized or debunked for not incorporating irrational emotional behavior. Now, a subfield of behavioral economics proposes that psychological influences and biases affect financial behaviors of investors and financial practitioners. One key aspect of behavioral finance studies is the influence of psychological biases. Now, there are many. I'm going to touch on a few that we see investors and clients kind of struggle through to try to effectively invest in stocks. Now, in the realm of investing, we will define behavioral finance, behavioral biases, as systematic errors in judgment, or systematic errors in financial judgment, or imperfections in the perception of economic reality. Now, they're cognitive, like I've said, and emotional biases. Both produce irrational judgments. I'm going to look first at cognitive biases, technically defined as basic statistical informational processing or memory errors that are common to all human beings. Emotional biases originate from the subjective feeling or intuition or impulses. Now, let's touch on a couple of the latter or emotional biases to start with, and we can discuss these as I go forward. The first would be loss aversion. Loss aversion bias was developed as a concept by Daniel Kahneman and Amos Tversky in response to observation that I can really pronounce names well, that people generally feel a stronger impulse to avoid loss than to acquire gains. The possibility of a loss is on average twice as powerful motivator as the possibility of making a gain of equal magnitude. For example, the pain of losing $100 is often far greater than the joy of gaining or finding the same amount. You can see there, $10, losing $10. Oh, a cruel world. So he's not that pumped about losing or getting the $10, but just
Did you draw
crushed.
Did you draw this?
Did I draw that?
Yeah.
No, that's way too good for me. Let's be honest. All right, and we can talk about loss aversion. We'll talk about these, I guess, at the end. But the next one would be endowment bias. Now, people who are subject to endowment bias place more value on an asset they hold property rights to than one they do not hold rights to. This behavior is inconsistent with standard economic theory, which says that a person's willingness to pay for a good or object should be equal to the person's willingness to sell that same good or object. Psychologists have found that the minimum selling prices that people state tend to exceed the maximum purchase price they are willing to pay for the same good. Investors in this, an example in the world of investing, investors continue to hold securities they own rather than disposing them in favor of better opportunities. Again, this is something we see play out in real time with investors, and it hurts their returns over the long term. Now I'm going to talk about a couple of cognitive biases. The first would be overconfidence. We define this generally as unwarranted faith in one's intuitive reasoning, judgment, or cognitive abilities. Investors tend to overestimate both their predictive abilities as well as their precision of the information that they have been given. They believe they are smarter and have better information than they actually do. An example of this, well, that would be an investor getting a tip from either an investment advisor or from a TV program, or they've read something on the internet about a stock and they buy it based on his or her perceived knowledge advantage that they have. Again, this is something we see all the time. Investors in our chat sessions, we get emails about it all the time. Get a tip from BNN or CNBC. It is just a small piece of information on the stock. They've not really done the requisite informational discovery or the due diligence necessary to invest in the company. They think they have a knowledge advantage, but it's not really there. Now, the final bias is a little more nuanced, but I will give an example at the end. It is called representativeness. It's a large word. There's going to be a lot of words in this slide. But representativeness, I'm going to define it here. Because human beings like to stay organized, they develop over time an internal system for classifying objects and thoughts. When confronted with new circumstances that may be inconsistent with existing classifications, they often rely on what we call a best fit process to determine which category should house and form the basis for understanding these new circumstances. This perceptual framework provides a practical tool for processing new information by simultaneously incorporating insight gained from past experiences. Now, sometimes, however, new stimuli are representative of elements that have already been classified, while in reality, there are differences. In such an instance, the classification reflex is wrong, and it produces an incorrect understanding of the new element that often persists and biases future interactions with that element. An investing example: an investor may be presented with an investment opportunity that contains some elements that are representative of a good investment. The investor's desire to mentally classify that investment opportunity may cause him or her to classify what is really a poor investment opportunity as a good one, based on the few elements that are representative of a good investment opportunity. We, on the flip side of this, we have to act to prevent this from entering into our own bias or analysis when we're looking at a company. I'll give you an example of that. When we initially, 6-7 years ago, came across a company called Dynacor, it was called Dynacor Gold at the time. We have an aversion to mining exploration companies, generally speaking, but we still look at all companies, and it is a good thing that we still continue to review all these companies, because we found it was less a mining company than an industrial ore processor, a great business. And if we had used that bias, or that bias had entered in it, this company may have not made it into our coverage. So you have to try to eschew that bias and to continue, in our research at least, to look at that company and find out, what does this business really do? And let's not have that bias in there because of the name of the company. All right, that's going to finish off my segment on biases and behavioral finance. Any comments, guys?
Yeah, I'm really glad that you did this as a segment, because behavioral psychology and really studying it like a science is something that investors don't do enough. I mean, when we think
I
about,
agree.
What you do in terms of like studying investing in your portfolio, it's usually like, well, I'll research individual companies, or I'll research like macroeconomics or economic indicators, or how to like calculate financial ratios, what they mean, interpretation. But in a lot of cases, investors, in some ways, the biggest risk that they face is really themselves in some ways, right? Because investors, and this is all of us, but human beings are prone to making certain mistakes and not necessarily knowing what those mistakes are, or that they are mistakes, and then repeating them over time, right? And one of the things that behavioral psychology does, and then looking specifically at the different biases, is it gives you more self-awareness over what you're doing, right? So when you study these, you start to think about your own actions and look at what you've done in the past, and think about like, okay, like, I was, overconfident there. There was loss aversion here. There's representativeness here. And like that gives you the opportunity to become a better investor, and probably in a more powerful way than learning, a little more about ratio analysis or macroeconomics.
Know the basis of those things, the basics of those things, but coming to grips with and being self-aware as to where your issues lie. And this is something that, when we talk to individual investors, we can do to help coach them kind of in those areas. Be it loss aversion, representativeness. I can't even say the word, but it's too large. But it's so many things that enter into your buy decision or your sell decision, or your decision to continue to hold, that if you are self-aware, like Aaron said, if you do know that it's something that you have suffered from in the past, you can take a deep breath kind of and say, am I looking at this buy, sell, or hold decision the right way? And they are things that almost every investor struggles with. They have some biases. I mean, every human being has a bias when processing any information, but in
And if
investing,
you
you
think you
certainly see
don't,
it.
then yours is bigger than
Yeah, yeah,
than most.
you have worse
Yeah.
problems, probably. Yeah, that's overconfident right there, probably.
Mhm.
If you think, no, I have no bias, that's
Yeah. And
ridiculous.
that's why I think like having like a trading journal, or sorry, investing journal, it's just call it trading journal just as a term,
Yeah,
but just to
Mhm.
be self-aware, get your, what was I saying in, 2018 about this investment? Why did I like it? And like track, your thoughts on that investment over time. And then I had two other points, just like on loss aversion. Like I have said this before on the podcast, but it's not just a stock market; it's a market of opportunities, like Ryan was basically saying in his
hmm
slide. And if an investment does go sour and the opportunity is no longer there, just allocate the capital to a better opportunity rather than continue to hold a stock which doesn't present an opportunity any longer.
yeah,
And another one that I really like, and this is I love quotes, and this relates to overconfidence bias. And this is a quote from Mark Twain that I love so much because it represents this so much. It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. And that is so true when it comes to investing is,
yeah,
if you're, piling in, 30, 40, 50% of your portfolio into a stock because that it's going to pay off, well, that's going to potentially get you in trouble. So, just keep that in the back of your mind if you are doing something like that.
yeah. And it just, with all of these psychological biases, it's an art, not a science. There's a science to investing too, but
Mhm.
there is the art of dealing with your psychological biases in investing. And even when you have loss aversion, it's not always as simple as, okay, this stock is down, so I sell it. In when we had the pandemic and stocks went down, like that was a time to steady yourself and buy. And you have to learn from those moments. And not every stock to buy, but there was some great opportunities out there. So you're down 20%, you don't just recycle that into something else. You look back, if you had that journal, or if you look back at one of our reports, or you reach out to us and say, look, I saw this stock go down 20-30%. Has your fundamental investment philosophy or your fundamental thesis for investing in this company changed? If it hasn't, then we're going to buy more, because that's the time to buy more. And those are your game kind of portfolio game changing opportunities if you can get a company that on sale that is a great business. All right, should we move on? We can
Yep.
talk more. There's more we could go into with behavioral finance.
For
I
sure.
think it would be interesting to. I think it's an interesting topic to go on.
I don't
So
know. One
we'll
thing
continue.
that maybe I'll mention is, if people are interested in us putting together some type of a behavioral finance course, like a mini course,
Oh,
post some
let's do
comments
that. Yeah,
or send us some messages, and that might be something that we'd consider.
yeah, for sure. I think it'd be great.